Welcome to this presentation by PolicePay.net, Understanding Governmental Accounting, Part 2. I'm Ron York, and welcome. Last time we talked about the two major reports that are turned out on governmental finance, the budget, the audit. We went into explanation of how they're different and why it's important to distinguish between the two. If you've not heard that or you don't understand it, you better go back and listen to that first, because it's a little hard to navigate the field if you don't understand the difference between those two documents. Today we're going to talk about the different methods of accounting used in these financial statements. And unfortunately for us, there's not one unitary method. In fact, there's three methods of accounting that are used in what we call the audit, the comprehensive annual financial report, and they all come up with a different number. So you have to know what to look at and when to look at which one. So we're going to go through this and talk about what the difference is. The first presentation that we have is a presentation called government-wide financial statements. Essentially what they are is a full accrual method of accounting, similar to what any business would use General Motors or Joe's Taco Stand. How accrual accounting works is we measure transactions when the transaction occurs, not necessarily when money exchanges hands. We measure long-term assets based upon how much of it we think we consume during a year. Under a cash basis of accounting, we recognize transactions when there's either money put in the bank or a check written to us. It doesn't matter what the check's for. If it's for $50 million City Hall, we count it just like it was buying office supplies. We just write the whole thing off first year. In accrual, we don't. We would take that City Hall and set it up and say, well, it's got a 50-year life, and each year we would take off 1/50th of the value of the cost. It's very interesting, and the government-wide financial statements do provide us a picture of what the city is consuming. It's divided into two parts, as we talked about earlier: governmental functions and business functions. Then it gives us a combining statement of both. That statement's probably not of a whole lot of value when we're looking at governmental financial activities, because we're more concerned about the sources and uses of funds than we are determining what our consumption rate is of the assets. So it's presented first. Very few people read it, even fewer understand it. So for the most part, I'd say just skip that until you get a little further along the road in experience. I wouldn't even bother reading those. The next set of statements is what we call the modified accrual method, which is incorrectly named, should be modified cash basis, but so be it. But the modified accrual basis is a pure cash basis accounting with one exception. We include payables and receivables, primarily what would either come in or be paid within 60 days after the close of the year, that's applicable to the year being measured. For example, if we earned sales tax for May and June and our fiscal year was June 30th, under the modified accrual method, we would go ahead and count May and June, even though we will not receive a check from the state government probably till July and August. So we have that exception. Pure cash basis, everything's measured when the transaction occurs, except we have this kind of 60-day window that we bring in transactions that are not yet settled at the end of the year, and we include them. Third method, budgetary method. Not really a set of rules for budgetary method. It varies from state to state, some places city to city. Not very many restrictions on it. But essentially, it's a cash basis, one pure cash basis with one exception. At the end of the year, we go in and we list out every purchase order that's not been closed out, and we count those, whether they're filled or unfilled. Now, a filled purchase order would be one where that we've ordered something, they've delivered it, but we haven't paid it. An unfilled purchase order would be one we've ordered something, but they've not delivered it. They may never deliver it. We may never pay for it, and we might pay for it. But we subtract those off. So the budgetary method is total cash minus encumbrances. That's the three methods of accounting that we use. Now, cities, when they run their business, they almost exclusively rely on the budgetary statements because they're concerned about complying with state law. And the state law generally provides that you can spend everything you bring in plus everything you have in the bank. What you cannot do is you cannot spend all that money and then go down to the First National Bank and get a 60-day loan to tide you by. And so everybody's always concerned about that limitation. And so all discussion around municipal finance is almost entirely using the modified or the budgetary method of accounting. Now, one good thing has occurred in the last few years. More and more states are moving toward using modified accrual method as their budgetary method, which is very good because there's a set of rules. The presentation and rules for budgetary accounting just varies from one place to the next. There's no consistency whatsoever. One thing that really causes a lot of confusion with these two types of accounting, a modified accrual and budgetary method that we use in the governmental function, is when we talk about fund balance ratios. And the Government Finance Officers Association has a ratio they think we ought to maintain, somewhere 5-15%, but that's based upon modified accrual numbers, but cities tend to want to try to use their budgetary numbers, and it's a mess. It doesn't make a lot of sense to use a methodology that's used for one method accounting on another, but it happens all the time. Now, the budgetary method does tell us something that the modified accrual does not. The budgetary method presented in the CAFR, or the audit, shows what the city projected at the beginning of the year, and of course during the year they're allowed to amend their projections, and most cities do. There's nothing wrong with that. And we can see what modifications they've made to it, and then finally we get over and see what actually occurred, and then there's a variance that shows us how much the actual number differed from the final budget. It's very important to look at that and see if that's relatively accurate. It's probably more important to look at that original budget to see how accurate those are. And most places do a very good job on estimating this. Now, one thing we can be certain of, and that is expenditures will always come under budget because there's no penalty for coming under, only a penalty for going over. So everybody plays it pretty close. They try to get as much as their budget is spent, but it's kind of impossible to do it. So we normally see 1 or 2 percentage points of unspent money in the expenditure side of the budget. Now, the utilities, which we're not going to talk about, they're ran like a business, so they use this full accrual method where they take depreciation, recognize assets as investments and not as a current expenditure. And that's the only presentation that we get of those. So that's all we have to rely on them. But keep in mind that although the budgetary method and the modified accrual method are very similar methods, they may come up with totally different results in any one given year. But in the long run, they all end up the same place. The only difference between any method of accounting and another method is just simply timing. I mean, it's assuming that both accounting methods count everything. They don't let stuff slide by without getting counted. But it's all just a matter of timing, especially when we're talking about accounts payable, bills, and so forth. It's that's kind of problematic, and that's about the only difference that we really see is just a timing difference. But that's what we're looking at. Now, the reason that this is important is to understand that is what we're going to be concerned about is the growth rate in revenues. So it is important how these revenues are measured, and I prefer to use the modified accrual method to make these measurements of what the growth rate is, because there's a universal set of rules that all cities, counties, and states must follow to prepare the modified accrual. Whereas the budgetary statements, they're all over the board. They're not nearly as reliable as the modified accrual statements. So let's kind of go over this again. What we have. We have 3 presentations. We have the full accrual, similar to General Motors' method of accounting, called government-wide financial statements. Forget them. Very few people understand them. Very few people use them. The second type method is the modified accrual, which is really modified cash. It's a cash basis accounting, but it includes 60 days worth of transactions that are settled, that are relevant to the previous year. Budgetary accounting is a strict cash basis accounting, except at the end of the year we collect all the outstanding, I should say, purchase orders, and we tally them up and we deduct them off and include them as expenditures. That's about it. That's the understanding of the 3 methods of accounting used. Hope this has been helpful. I look forward to talking with you in part 3.